Welcome back to the deep dive. I want to start today with a scenario that used to drive me absolutely crazy.
Okay, I'm listening.
You're scrolling through real estate listings on a Saturday morning, because that's what we do for fun now, and you see this rundown duplex in the middle of nowhere, Ohio.
Yeah.
Let's say it's listed for $100,000.
Okay, I can picture it. Peeling paint, maybe a chain link fence.
Exactly. And then you switch tabs to some high-end commercial listing site, and you see a single parking spot, and I mean literally just a slab of concrete with painted lines in downtown Manhattan or maybe Hong Kong.
Right.
And it is listed for the exact same price, $100,000.
It happens more often than you'd think, especially in dense cities.
It does. And as a normal person, you look at that and you think, okay, the price tag is the same, so they must be worth the same. Just simple logic. But then you talk to a professional investor, and they almost laugh at you. They tell you the parking spot is a safe haven, and the duplex is a money pit. Or, depending on the year, maybe it's the other way around. The point is, they're seeing a layer of data that is completely invisible to the price tag.
They aren't looking at the price, they're looking at the engine inside the price.
Exactly. And that engine is what we are going to take apart today. We are tackling the capitalization rate, or as everyone calls it, the cap rate.
The infamous cap rate.
And I'll be honest, when I first saw this topic in our research stack, I wanted to run. It sounds like the driest, most boring piece of financial jargon imaginable.
It sounds like homework.
It really does. It sounds like something you learn in an accounting class you're trying to sleep through. But as I went through the CBRE data, the NCREIF historicals, and the case studies we have for this deep dive, especially that Stuyvesant Town disaster in New York, I realized I was completely wrong.
It grabs you once you get into it.
It does. The cap rate isn't just math. It's a universal translator. It's the only tool that lets you compare that Ohio duplex to a Manhattan skyscraper and actually understand which one is the better bet.
That is the perfect way to frame it. Think of the cap rate as a thermometer. If you walk up to a building, the price tag tells you the size of the building, maybe its grandeur.
Right, its physical presence.
But the cap rate tells you the temperature of the market surrounding it. Is it overheating? Is it freezing cold? Is it a risky bet that might burn you? Or a safe bet that will take, 30 years to pay off? It's a vital sign.
So our mission today is to give you, the listener, that thermometer. We're going to move beyond the basic arithmetic, though we will absolutely do the math, and look at the story this number tells about risk, about market psychology, and about the future.
We're going to look at the math, but we're mostly going to look at the psychology behind the math, because ultimately real estate value is just a collection of human expectations about what the future holds.
I love that. Okay, so let's start at the very beginning. Section 1, the core mechanism. If I'm at a cocktail party and I want to sound smart, how do I define a cap rate without boring everyone to death?
At its most basic, most fundamental definition, the capitalization rate is a ratio.
Okay, a ratio of what to what?
It is the ratio between the annual rental income produced by a real estate asset and its current market value.
So income divided by value.
Precisely. The formula, if you want to write it on a napkin, is capitalization rate in annual net operating income current value.
Okay, and we're going to spend a lot of time on that net operating income part because it's tricky.
Oh, it's a minefield.
But before we do, I need a simple example, a back of the napkin example. Let's say I'm buying a building.
Let's stick to the primary example from our source material. The math is very clean. Imagine a building is purchased for a sale price of exactly $1 million.
Okay, I've got $1 million building.
And let's say that building produces $100,000 in positive net operating income, or NOI, in a single year.
Okay, so $100,000 in income.
To get the cap rate, you take that $100,000 of income and you divide it by the $1 million cost.
100,000 divided by a million. That's 0.10. So 10%.
Correct. The capitalization rate is 10%.
Which means what exactly?
What?
Does that mean I made a 10% profit on my money?
In a way, yes. It
Yeah.
means that in a single year, 1/10 of the building's total cost is paid for by the net proceeds it generates. It's a yield. If you put that $1 million into a high-yield savings account, the interest rate would be your yield.
I see.
In a building, the cap rate is your yield assuming, and this is a big assumption for now, that you paid all cash.
Okay, so it's like the building's annual dividend. That brings up this concept from the sources of the payback period, right? Yeah. Because if I'm getting 10% of my money back every year, simple math says it takes me 10 years to get my $1 million back.
Exactly. Capitalization rates are an indirect measure of how fast an investment pays for itself. At a 10% cap rate, the payback period is 10 years.
1 divided by 0.10.
Now let's flip it. Imagine a different scenario. Same $1 million building. Looks identical from the outside. But the cap rate is 5%.
So wait, for it to be 5%, that means the income must be lower. Same $1 million price tag, but now it only makes $50,000 a year in NOI.
Right. 50,000 divided by a million is 5%. Now, what's your payback period?
Well, 1 divided by 0.05. That's 20 years.
20 years. So here is where it gets really interesting, and this is the part that is so counterintuitive for beginners.
Right.
If you see a building with a 10% cap rate and another one with a 5% cap rate, your gut instinct, your immediate reaction is to say,
Wow, 10% is way better. I get my money back faster. Double the return.
of course.
Yeah, obviously. Who wants to wait 20 years to recoup their investment when they can wait 10? In almost any other part of life, faster and higher returns are better.
But in the world of professional real estate, a lower percentage often, not always, but often signals higher quality.
Wait, unpack that for me. How can a lower return possibly mean higher quality? It just feels wrong.
Think about it from the perspective of risk. Why would any rational investor accept a 5% return and agree to wait 20 years to get their money back? What has to be true for that to be an attractive deal?
Well, they wouldn't unless.
Yeah.
Unless they were incredibly sure they were actually going to get that money.
Right.
Like rock solid sure.
Exactly. They accept a lower return because they believe that income stream is incredibly safe and reliable. Or, and this is another piece of it, they believe the value of the building itself is going to skyrocket in the future.
So they're paying a premium for safety or for growth.
Precisely. They are willing to pay more money today for that stream of income, which pushes the cap rate down. Conversely, if a building is offering you a 10% cap rate, or a 12% cap rate.
It's probably risky. It's the old, if it sounds too good to be true, it probably is rule.
That's the first question a pro asks. What's the catch? Maybe the tenants are on shaky ground and might leave next month. Maybe the roof is about to cave in and needs a $100,000 repair. Maybe the whole neighborhood is declining. The market is forcing the seller to offer a high yield, a sweetener, if you will, to attract a buyer to take on that mess. So a high cap rate often means cheap building, high risk, while a low cap rate often means expensive building, low risk.
That is such a crucial distinction. The cap rate isn't just what you get. It's what the market demands you get to convince you to take on the associated risk.
Yes, it is the price of risk quantified as a percentage.
Okay, that's a huge piece of the puzzle. But before we get too deep into the psychology of risk and growth, we have to talk about the inputs. We keep saying net operating income or NOI, and I feel like there's a giant trap here.
There is.
Because income can mean so many things. If I ask my accountant what my income is, he gives me one number. If I ask the IRS, they give me a totally different number.
This is the single biggest mistake people make when they first try to value real estate. We are in Section 2 now, defining income correctly. That numerator in the fraction, the top number, is net operating income. It is not just profit in the loose sense, and it is absolutely not cash flow.
Okay, so let's distinguish those for me. What actually goes into calculating NOI, step by step?
You start with gross lease income. That's all the rent checks you collect, plus any other income, like from laundry machines or parking fees.
The total amount of money that comes in the door.
Right. Then from that, you subtract the fixed and variable operating costs, the things you have to pay for to keep the building running.
So property taxes.
Yes. Even though you hate paying them, they are a direct cost of operating the business. They come out.
Insurance.
Yes, property insurance, that comes out too.
What about fixing the toilet that broke in Unit 3 at 2 a.m. on a Sunday?
Absolutely. Repairs and maintenance. You also subtract landscaping, snow removal, any utilities the landlord is responsible for, property management fees if you hire someone. All those are operating costs necessary to keep the building functional and rented.
Okay, so far so good. That all seems logical. Now, what is excluded? What do we purposefully leave out of the math that might surprise people?
This is the critical distinction. First, you exclude depreciation. That's a non-cash tax write-off. It's an accounting concept, not a real expense.
Okay, makes sense.
You also exclude the owner's personal income taxes. And, this is the big one, the one that everyone gets wrong, you exclude mortgage interest, also known as debt service.
Okay, I have to stop here because we just hit the most controversial part of the formula. You were telling me we exclude the mortgage payment.
Correct. You do not subtract debt service when calculating net operating income.
But hold on a second. That sounds completely insane. If I buy a building, the mortgage is the single biggest check I write every single month. It leaves my bank account. It is a very, very real cost. If I ignore it, aren't I just lying to myself about how much money I'm actually making?
You're asking the exact right question. If you were calculating your personal cash flow, the money you can take home and spend on groceries, then yes, ignoring the mortgage would be lying. But remember our mission. The cap rate isn't about you, it's about the building.
Make that make sense for me. I'm struggling with this. Why does the building not care about my mortgage?
Okay, let me give you an analogy. Picture two identical buildings, Building A and Building B. They are right next to each other, built by the same contractor, same floor plans, same tenants, same rent. They both bring in $100,000 a year in NOI.
Okay, they're identical twins.
Exactly. Now, Building A is bought by a massive pension fund, let's say a teacher's retirement fund. They have billions in cash. They pay all cash for the building, no mortgage.
No debt. Must be nice.
Right. Now, Building B is bought by a young investor who scrapes together a small down payment and borrows 90% of the purchase price from the bank. He's leveraged to the hilt.
Okay, so building A has no mortgage payment. Building B has a massive one.
A huge one. So if we included the mortgage in the valuation calculation, Building A would look like a gold mine, huge positive income. Building B would look like a total disaster, almost zero income, because it's all going to the bank to pay the loan.
Right, on paper, they look like completely different investments.
But are they, physically? Are the assets themselves different? They are the same pile of bricks, the roofs are the same, the tenants are paying the same rent, the buildings are performing identically.
Right, the bricks haven't changed, only the owner's financial situation is different.
And that is exactly why we use the cap rate. It strips away the financing structure, which is unique to each individual buyer, and it looks purely at the underlying asset performance. It lets you compare assets on an apples-to-apples basis.
I see. So it allows the pension fund to look at Building B and say, I don't care that the current owner is broke and over-leveraged. The machine itself produces $100,000 a year.
Precisely. It isolates the real estate quality from the financial engineering. It answers the question. If you paid all cash for this asset, what would its unlevered yield be?
That makes total sense. It clarifies the view. It took me a minute, but I'm there. But there's another trap you mentioned from the source material. They called it the undefined trap.
Yes, this is a fun mathematical quirk that actually teaches an important lesson.
This happens with inherited buildings, right?
Right. It's the classic example. Let's say your great aunt Mildred leaves you a 10-unit apartment complex in her will. You get it for free. Your cost basis, what you paid for it, is zero.
Best day of my life.
Financially, yes. But if you try to calculate your return on investment based on what you paid.
Well, the income is, say, $50,000.
Yeah.
And I divide that by my cost, which is zero.
What happens when you divide by zero?
The universe implodes. It's undefined. Your calculator gives you an error message.
Exactly. You cannot calculate a cap rate based on initial cost if that cost is zero. And this brings us to a vital point that leads to our next section. Cap rates should always be calculated based on current market value, not your historical costs.
Which segues perfectly into Section 3, the time value of money and the sneaky, powerful concept of opportunity cost. Because this is where people, especially long-term owners, trick themselves.
They do all the time. We call it the 20-year owner scenario. It's a classic mental error.
Walk us through this one.
Okay, let's look at the detailed example from our source material. An owner, let's call him Frank, bought a building 20 years ago for $200,000. It was a great deal at the time.
Okay, Frank's feeling pretty good about that purchase.
He is. Today, that building, due to market appreciation, is now worth $400,000. And the NOI, the income it produces after expenses, is a very healthy $100,000 a year.
Not bad at all. Frank's doing well.
Now, you go to Frank and you ask him, Frank, what is your return on this building? He'll often look at his original checkbook. He'll pull out the old file.
He remembers the day he wrote that check.
He does. And he says, well, it's simple. I paid $200,000 and it makes me $100,000 a year. That's easy math. I'm making a 50% return.
And he feels like a genius. He's probably bragging about his 50% return at the golf course.
He feels like Warren Buffett. But he is wrong. He's fooling himself.
Why is he wrong? I mean, 100,000 divided by 200,000 is 50%. The math works.
The arithmetic works, but the economic logic is flawed. He is ignoring the $400,000 that the building is currently worth. He's ignoring the value that's sitting right there on the table.
What do you mean?
By choosing to keep the building today, he is effectively choosing not to sell it for $400,000. That $400,000 is the real amount of capital currently tied up in this deal.
So the real math, the correct math, is the $100,000 of income divided by the $400,000 current value.
Which gives you what?
A 25% cap rate, which is still amazing, by the way. Most investors would kill for that. But it's not 50%.
It's not 50%, and this is the core of opportunity costs.
Explain that concept.
Think of it this way. Every single morning you wake up and you don't sell your house, you are effectively buying it again at today's market price.
Ooh, that is an uncomfortable thought. It reframes ownership entirely.
It is uncomfortable, but it's the truth for a rational investor. Frank, in our example, is effectively buying that building for $400,000 every single day by not selling it. So the real question isn't what's my return on my old money. The question is 25% the best return I can get on my $400,000 today?
Right. Could he sell it, take that $400,000 and put it into stocks, into bonds, into a different, better building that yields 30%?
Exactly. The market doesn't care what you paid in 1995. The market only cares what that capital is worth today and what it could be doing instead.
That is a huge mindset shift. It stops you from being sentimental about an asset. Oh, I've owned this for 30 years. That doesn't matter.
Real estate is no place for sentimentality if your goal is to maximize returns.
So let's move to section 4, the 3 levers. We know what the cap rate is. We know how to calculate it properly. But what actually moves it? Why is it 5% in one city and 10% in another? Why does it change from year to year? There is a scary-looking formula in our notes. Cap rate, risk-free rate, plus risk premium growth rate.
It looks complex, and the full academic version is even worse, but we can simplify this into 3 core drivers. Think of them as 3 levers that are constantly pulling the rate up or pushing it down.
Okay, good. Let's play a game with this. I'll name the lever from our research, you explain how it works, and then I'm going to give you a hypothetical building scenario, and you tell me how the lever applies.
I like it. Let's do it.
Okay, lever number 1, the opportunity cost of capital.
This is usually tied to what's called the risk-free rate, which is the yield on government bonds, like a 10-year U.S. Treasury.
Why that?
Because commercial real estate competes with other assets for investor dollars. If I can get a 5% guaranteed return by buying a U.S. Treasury bond backed by the full faith and credit of the government, why would I buy a building for a 4% return and have to deal with tenants, toilets, and taxes?
You wouldn't. It's a no-brainer.
So if bond rates go up, making them more attractive,
Then demand for real estate goes down. Investors move their money to the safer, easier asset.
Exactly. And when demand for real estate falls, prices fall. And as we know from our formula, if the value, the denominator, goes down, the cap rate goes up.
Okay, scenario time. I am selling a generic, boring office building in a generic city. It's fine. It's okay. Class B, 90% occupied. But suddenly, the Federal Reserve hikes interest rates by 2% to fight inflation. What happens to my cap rate?
Your cap rate almost certainly goes up. Because your building is boring and stable, it doesn't have some crazy growth story. It's competing directly with those bonds for capital. If bonds now pay more, you have to offer a better yield to compete. The only way to do that is to lower your price, which pushes your cap rate up.
Ouch. So the Fed just cost me money, even though my building didn't change at all.
The Fed just repriced your entire asset class.
Okay, lever number 2, growth expectations.
This is the greed lever, the sexy one.
I like this lever.
If rents in a market are expected to rise dramatically, say you're in a booming tech hub like Austin or Miami in the right year, investors will pay a huge premium to get in today.
They're willing to accept a tiny amount of income right now because they believe that income will double or triple in 5 years.
Yes. So a higher price for the same income equals a lower cap rate.
It's like buying a growth stock. You buy Tesla or Amazon back in the day, you're not buying it for the dividend they pay now, which is 0. You're buying it for the future earnings.
It's the exact same logic. A low cap rate often signals the market has very high growth expectations.
Okay, scenario. I own a pretty standard warehouse, but it's not just any warehouse. It's located right next to the main airport, in a city where a major tech company just announced they are building their new massive headquarters.
The growth lever gets pulled all the way down, hard. Investors will be falling over each other to buy that warehouse. They'll bid the price up so high that the cap rate might drop to 3% or even 2.5%.
Wow.
They don't care that the yield is low today because they know that in 5 years, every company that wants to be near that new headquarters will need logistics space, and your warehouse will be a gold mine. They're buying the future.
Got it. Okay, last one. Lever number 3, risk.
The fear lever.
The opposite of the greed lever.
Right. Risk moves in tandem with cap rates. It's a direct relationship. If you have a high-risk asset, maybe it has a single tenant, a startup that might go bankrupt, or it's in a bad location in a shrinking city, an investor is going to demand a much higher return to take on that risk.
They need a bigger cushion in case things go wrong.
You got it. High risk equals high cap rate. And the flip side is true. Low risk, like A brand new building in a prime location leased to the federal government for 20 years. That's going to have a very low cap rate.
Okay, scenario. I own a shopping mall. It was built in 1980. The anchor tenant was a Sears, and they just went out of business and closed. The roof leaks. And it's located in a town where the main factory just shut down and the population is dropping.
Oh boy. That is the fear liver maxed out and then broken off. That is a trifecta of pain.
What happens to my cap rate?
No one wants that headache. To sell that property, you would have to drop the price so low that you're offering a massive cap rate, maybe 12%, 14%. It could even be higher. You are basically paying someone to take this disaster off your hands, and you're compensating them with a huge yield for the sleepless nights they're about to have.
So if I'm a buyer and I see a building with an 8% cap rate in a market where everything else is trading at 5%, I shouldn't just think, good deal. I should be thinking, what's wrong with it?
That's the professional mindset. Your first thought shouldn't be, wow, a bargain. It should be, what is the market seeing that I am not? Is the tenant about to leave? Is the building about to need a new HVAC system? Is there new competition being built across the street? That 8% is a warning sign as much as it is an invitation.
So it's this constant tug of war between these three things: interest rates, growth, and risk.
Always. And the best investors are the ones who can correctly identify which lever is pulling the hardest at any given moment in the market cycle.
Okay, now we get to do some magic. Section 5. Valuation and what you call the reverse math. This is what appraisers and investors use to basically figure out what a property is worth, right?
It feels like magic, but it's just a little bit of algebra. This is called the direct capitalization approach to valuation.
So usually we have the formula income value equal cap rate, but we can just flip the equation around.
Algebra is our friend here. If we rearrange the terms, the formula becomes value NOI cap rate.
So if I know how much money a building makes, and I know what the market cap rate is for that type of building in that location, I can tell you exactly what it should sell for.
You can get a very good estimate. Try it with an example. Let's say you're looking at a small apartment building, and you've determined it produces $10,000 in NOI per year.
Okay, small building, 10 grand in income after expenses.
And you do your research, you look at recent sales of similar buildings in the area, and you see they're all selling at roughly a 7% cap rate.
So I take my income, $10,000, and I divide it by the market cap rate, 0.07.
And what do you get?
Let me pull up a calculator.
Yeah.
$10,000 divided by 0.07 is $142,857.
That is the estimated value of your building. Simple as that.
Now, here is where it gets really crazy. This is the value add strategy that every real estate guru on the internet talks about.
Oh, yes.
Let's say I buy that building. I go in, I spend a little money, I paint the walls, put in some nicer countertops, and I'm able to raise the rents across the board. Let's say I increase the NOI from $10,000 a year to $12,000 a year. Just a small $2,000 increase.
Okay, a very achievable goal. Now run the math again.
All right, new NOI is $12,000. The market cap rate is still 7%. So $12,000 divided by 0.07 is $171,428.
So wait a minute. You increase the annual income by only $2,000, but you increase the value of the entire building by, what's the difference there? Almost $30,000.
That is the multiplier effect. That's incredible.
It is. At a 7% cap rate, every single dollar of new income you add to the property creates about $14 of value. If you were in a market with a 5% cap rate, every dollar of income creates $20 of value.
That explains why investors are so obsessed with raising rents and cutting costs. It's not just about the extra cash flow each month. It's about this explosive effect on the resale value of the asset.
Exactly. But
Oh no, there's always a but.
the multiplier works both ways. Let's say you do nothing to the building. Your income stays at $10,000, but the market changes. The Fed raises rates, things. So just a moment ago, your building was worth over $142,000. Now it's worth $100,000. You just lost over $40,000 in value, and the building's income didn't change by a single penny.
Whoa, that is terrifying. Your net worth can get hammered by market forces completely outside your control.
That is the power and the danger of the cap rate. A small shift in that rate, just 2 or 3 percentage points, can wipe out nearly 30% of your equity. This is why real estate cycles can be so brutal. You can be running the building perfectly, collecting all your rent, but if interest rates rise or market sentiment sours, your asset value can evaporate.
That is a perfect, if terrifying, segue to Section 6, Historical Trends and the Danger of Optimism. Because we have seen this movie before.
We certainly have. Let's look at the data from the Wall Street Journal that was mentioned in our source stack. It's a classic case study.
The lead up to the 2007-2008 crash.
Exactly. Between 2001 and 2007, we saw something unprecedented in the commercial real estate market. The average cap rate for office buildings in central business districts dropped from about 10% all the way down to 5.5%.
A drop from 10% to 5.5%. That means prices skyrocketed relative to the income they were producing.
Prices nearly doubled purely on what we call cap rate compression. It was a mania, money was cheap, optimism was high, and people were paying more and more for the same dollar of income.
And there was one specific deal that stands out as the poster child for this whole era of mania. We have to talk about the Stuyvesant Town deal.
Stuyvesant Town and Peter Cooper Village in New York City. This story is legendary in real estate circles. It's the ghost story investors tell their junior analysts around the campfire.
Set the scene for us. It's 2006. The market is absolutely frothy, and a partnership of Tishman Speyer and BlackRock decides to buy this massive apartment complex in Manhattan. We're talking 110 buildings, over 11,000 apartments. The price tag was $5.4 billion.
At the time, it was the single biggest real estate deal in U.S. history.
And when analysts ran the math on what they paid versus the income the property was generating at the time, the resulting cap rate was, wait for it, 3.1%.
3.1%.
I want you to contextualize that for me. Why is a 3.1% cap rate so unbelievably scary?
Well, let's go back to lever number one, the risk-free rate we talked about. At that time, in late 2006, you could buy a 10-year U.S. Treasury bond and get a yield of about 4.6% or 4.7%.
Wait, pause. Let me make sure I understand this. I could lend money to the United States government, a guaranteed return, zero risk of default, and get nearly 5% interest.
Correct.
But these incredibly smart investors at Tishman Speyer and BlackRock bought a huge, complicated building full of toilets and tenants for a 3% return. That's a negative risk premium. That makes absolutely zero sense on the surface.
On the surface, it's financial madness. Why accept 3% on a risky asset when you can get almost 5% on a risk-free one? It's a higher interest rate than the building was yielding. They were guaranteed to lose money on every dollar they borrowed from day one.
So why on earth did they do it? Were they just stupid?
No, they were incredibly ambitious. They were pulling the growth lever we talked about earlier. They weren't buying the property for that 3% yield. They were betting that the 3% was a lie.
What do you mean a lie?
They believed the income was artificially low. A huge portion of Stuyvesant Town was rent stabilized. You had tenants who had been there for decades paying 1980s prices for rent. The investors' entire thesis was, we are going to go in, find ways to get these people out, deregulate the units, and bring all the rents up to the much higher market rates.
So they thought they could aggressively double or triple the NOI in just a few years.
Exactly. They priced the deal not on what it was, but on what they hoped it would become. They paid for a perfect future. They thought that 3.1% yield would quickly turn into a 10% or 12% yield through that aggressive growth.
And as we know from history, that perfect future didn't materialize.
Not even close. The Tenants Association fought back tooth and nail. The courts blocked their deregulation plans. And then the knockout blow. The 2008 financial crisis hit. The growth lever snapped off in their hand. And because they had billions and billions of dollars in debt,
The negative leverage just ate them alive.
they defaulted, walked away, handed the keys back to the lenders. Billions of dollars in investor equity just vaporized. It is the ultimate lesson in real estate. A low cap rate is often disguised as safety, but it can actually be a measure of speculative mania.
Wow. And then the rebound. What happened after the crash, say, in late 2009?
The fear lever took over. Cap rates shot back up dramatically. The data shows that office buildings in central business districts went from that 5.5% low back up to 8.8%. Apartment buildings went back up to 7.36%.
Prices fell faster than rents.
Much faster. The market was correcting. It was resetting the risk premium to a more sane level.
Now, let's bring it to a more modern context. We have data from a CBRE survey from early 2021. This gives us a baseline for what normal looked like before the recent inflation spike and rate hikes.
Right. In early 2021, multifamily housing apartments were trading at cap rates between 3.5% and 5.0%.
That's very low again. High demand, perceived as very safe.
Extremely high demand. People always need a place to live. It's considered the most defensive asset class.
What about urban office buildings at that time?
They were in the range of 4.5% to 6.5%, a bit higher, a bit more risk with the rise of remote work.
And retail, malls and shopping centers.
That was trading from 5.0% to 7.0%. Retail is generally seen as riskier because of the Amazon effect and changing shopping habits, so investors demand a higher return to own it.
It's fascinating to see how the different asset classes stack up, each with its own risk profile reflected in its cap rate.
You can read the entire story of the economy just by looking at the spread between those numbers.
Okay, let's move into the final stretch. Section 7, Advanced Concepts. We're going to talk about reversionary value and total return. This sounds like the graduate level course.
It is, but it's not as complicated as it sounds. So far, we've mostly talked about the current income, which in industry terms is often called passing rent, what the tenants are actually paying right now.
Okay, passing rent.
But a professional valuer, an appraiser, also looks at something called an ERV,
ERV.
estimated rental value. This is what the space could theoretically rent for in the open market today if it were vacant and you were signing a new lease.
Ah, okay. So if I have a tenant who signed a 5-year lease 4 years ago, and they're paying $20 a square foot, but the market for new leases is now $40 a square foot.
Your passing rent is $20, but your ERV is $40. The huge difference between the two is the reversionary value. It's the hidden, locked-in upside potential. When that lease expires in 1 year, the value of that income stream reverts to the much higher market level.
So a savvy investor might look at a building with a low cap rate based on its current income, knowing that the real cap rate, based on ERV, is actually much higher.
Exactly. They are hunting for that spread. They look for mark-to-market opportunities. Conversely, if the passing rent is equal to the ERV, the building is said to be rack rented.
Rack rented. That sounds painful.
It just means it's fully rented at current market rates. There's no hidden upside in the leases. What you see is what you get.
Got it. And then there's the idea of total return, because the cap rate is just the income part of the equation, right?
Right. The cap rate is like the dividend from a stock.
Okay.
But we also care about the stock price going up or down. We care about appreciation.
So how do you calculate total return?
The simple formula is total return, cap rate, plus the change in the asset's value.
So if I buy a building at an 8% cap rate, and over the year the building's value goes up by 2%.
Your total return for that year is 10%, 8 plus 2.
And if I buy at an 8% cap rate, and the market turns, the value drops by 2%?
Your total return is only 6%, 8 minus 2. You still got your income, but the loss in value ate into your overall profit.
And using leverage taking out a loan amplifies this dramatically.
Massively. We talk about LTV, loan to value. If you put 25% down and borrow 75%, a small 2% increase in the building's value can create an 8% increase on your actual cash equity. But a small 2% decrease can create an 8% loss.
It's a double-edged sword. It cuts both ways.
Always. Just ask the owners of Stuyvesant Town.
Right. Finally, let's wrap up with Section 8. Limitations and nuance. Is the cap rate a perfect tool?
No tool is ever perfect. The single biggest flaw of the cap rate is that it is static.
It's a snapshot in time.
Exactly. It looks at a single year of income. It doesn't inherently account for future rent growth or future capital expenditures unless you adjust your expectations for the rate itself. It assumes the status quo continues forever.
And real estate is inefficient, right? It's not like the stock market where the price is updated every second and is the same for everyone.
Correct. Real estate markets are slow, opaque, and inefficient. Two different appraisers can look at the same building and come up with two different justifiable cap rates. That's why sophisticated investors use multiple valuation methods.
You don't just rely on this one number.
Never. They use direct capitalization, which is what we've been talking about, but they also use market comparables, looking at the price per square foot of similar physical buildings, and they use replacement cost. How much would it cost to build this exact building from scratch today? You triangulate to find the truth.
You never trust just one number.
Never.
So after all that, what does this all mean? Let's summarize this journey.
I think if we boil it all down, the cap rate is the bridge. It's the link that connects the physical asset, the bricks, the glass, the land, to the world of finance and financial return. It encapsulates everything we talked about: risk, opportunity cost, and growth expectations, all rolled into a single elegant percentage.
And for you, the listener, the practical takeaway is this. Whether you are looking at buying a small rental property, investing in a big public REIT, or even just reading the business section of the newspaper, look at the cap rate.
It tells you how the market feels about that asset. Is it a safe, boring bet, a low cap? Or is it a risky venture that could be a home run or a strikeout, a high cap?
It turns you from a passive observer, just looking at a price tag, into an active analyst. Gives you a kind of X-ray vision into the deal.
It absolutely does.
I want to leave everyone with a final provocative thought. Based on what we learned about Stuyvesant Town, and the nature of risk.
Go for it.
We tend to think low numbers are safe. A 3% cap rate sounds safe and stable. It sounds like a government bond. But if a cap rate is that low, it implies the market is betting heavily, maybe desperately, on future growth to justify the astronomical price being paid.
Correct. The price is baked in a perfect future.
But as we saw with that deal, and as we're seeing in some markets today, what happens when the future refuses to cooperate? In a world of changing interest rates and economic uncertainty, is that supposedly safe, low-cap asset actually the riskiest bet of all?
That is the multi-billion, maybe multi-trillion-dollar question. When you pay for perfection, you better hope you get perfection, because there's no margin for error.
Exactly. Thank you for walking us through the DNA of real estate value.
My pleasure. It was fun.
And to our listeners, keep crunching those numbers. We'll see you on the next deep dive.